Right. All right, guys. Well, hey, we're going to go ahead and start. Thanks for coming out again. My name's Jin. I am the host of this thing. This is our fourth, yeah, our fourth meetup. Before, it used to be an open meetup where just people came up and drank beer and talked about real estate, right? But this year, Darius and I decided, hey, we should probably get a little bit more organized. I also started going to Alumni's meetup. That's where I met you and showed me what a real meetup looked like. But even then, ours is still a lot more chill than his, if you guys have been to his. So, but anyways, today we have Charlie. He's going to be talking. He's a very experienced investor. He's been investing before I was born, I believe. And
Probably.
and he's going to be today. He's going to be talking about one little thing, right, that we need to be aware of when it comes to investing in real estate, and that's finding funding. So, Charlie, take it away.
Thank you. All right. Darius and Jin, thank you very much. I need to point out a dignitary in the room, Omni Casey. Omni has started the Cash Flow Breakfast Club a few years ago. So I think a lot of you guys I know are plugged in. I don't know if you're plugged in or not, but if you're not plugged in, plug into his meetups as well. Because, you know, the more meetups that you can go to, the more investors you can see, the more ideas you can get, right? Because, you know, at the end of the day, it's all about your network, right? You've got to get a good network. And, you know, obviously add me as part of your success network. And we were just talking about, one of the things we were talking about earlier was what makes the all-star team, right? You gotta have that team. Whether you're doing buy and holds, whether you're doing fix and flips, whether you're into commercial real estate, maybe the big apartment complexes, those kinds of things, you've got to build your team, right? Because that's a critical juncture, right? Who can you pick up the phone and call such and such, right? What will they do for you? And so that's very, very critical to this business. So I would strongly suggest that you guys go to as many meetups as possible. Tonight, what I'm going to talk about, it's how and where to find the money, right? A lot of times in this business, and I'm going to talk about a couple different things, but a lot of times in this business, people come and they're worried about the money. And I always tell people, the money's the easy part. The money, it shouldn't be your obstacle. Because it's all about finding the deals. Because once you find the deals, the money is begging you to come. So keep that in mind as I'm talking, even though this isn't a presentation on how to find the distressed assets. This is actually a presentation on investor-based money sources. Things, should I wait for these guys? You got some good. Okay.
They're late and they're
late, it's their fault. All right. This is my background. Wait a minute. How old are you?
I'm 32.
Oh,
Not quite.
25 years. 25 years. So close. Shoot, I got kids that are 29 and 30. So 25 years in investing. I've been a licensed realtor in Virginia, older than you, since 1991. I'm an engineer by trade. I got an electrical engineering degree. Part-time realtor since 1991. But I was a realtor because I wanted to be an investor. I didn't want to list houses. I didn't want to take buyers. I didn't want to do that. It was investing first. And when I was in college, getting my degree, my mom was sending me books, gold mining and foreclosures, how to buy a house in 30 days with no money down, the Robert Allen books. So she was sending me all kinds of real estate investing books. And so when I was in college getting an engineering degree, thinking that the best way to do it was to go get an engineering degree, go get a job, and that's the sign of success. Because back then, that's what people sat back on. It. There wasn't any of this real estate investing stuff. It wasn't, like it is today. And so that's how I pretty much got started. That's how my interest got piqued, right? And so for us, we're very fortunate because if you love what you do, like we do, you'll never work another day in your life. And that's true, right? We're still doing it. We're still going strong. I mean, I am obviously older and people are always looking at me. And I can always tell the faces. They're looking at me and they're like, well, hell, if you have all this money, what the hell are you doing standing in front of me? Right? And I get it. I get it. But sometimes for some of us, though, we like to give back, right? And so we're at the point of our careers where, yeah, we still have a pretty thriving businesses, and we would like to give back. And that's sort of what we do, because by us giving back, we build relationships. And as Omni will tell you, the journey is fun, but the relationships are better, right? Because once you get the money, it's okay, it's fun, but it's the people you meet along the way, it's the journey. And so that's why we're here. I am an owner of a brokerage, Virginia, Maryland, and DC, even though I'm not have a broker license. Part of Jackson LLC all night. My partner will be here soon. You need to probably talk to him later. We own a company called Clear Sky Properties. We fix and flip houses within that company. We've probably fixed over 400 houses, and that's kind of my progression into the hard money business. We have a pretty good sized rental portfolio as well, because along the way, as we were fixing and flipping houses, at the very beginning, we were fixing and flipping quite a few houses, and we were building up our capital stack, but we did keep a bunch of them as rentals. 1% rule, 100 times rents rule. So we have a good sized rental portfolio under Clear Sky Properties. Clear Sky Financial, it's a hard money company. We lend money out to fix and flip investors, buy and hold investors. We own an industrial parking lot. We own some commercial assets. The industrial parking lot's industrial land. We just are a truck for tractor trailers. We got it spaced out to about 70 spaces. We charge about $400 a month in rent for each space. So that's not bad. So as you get more and more sophisticated in your investing career, you're going to end up doing different things. You're going to branch out. You're going to get more diversified. Okay. And there's a bunch of other things that we have done. One of the things I need to stress on is that I'm president of a nonprofit called Catholics for Housing, Citizens for Housing. We're in the low income housing space, charity. We own a trailer park. We own about 40 rentals, some Section 8s, just some lower income res. So I do that. I also have a charity called Clear Sky Sports Angels. I give money to kids that can't play travel sports because they can't afford it. So I'm trying to bridge the gap amongst the younger kids in Northern Virginia. I do travel soccer, AAU basketball. So I contribute money to that, and it's a foundation. So I do that. So that's one of the things that I want to stress, because just like Omni will tell you guys, we're only here for a short period of time, but you got to make the world a better place. And we believe that. And so that's kind of what we do on a charitable cause. The Clear Sky Group, again, Clear Sky Properties, we still fix and flip houses. People tell me all the time, why the hell are you doing it? The chase is fun. Finding them is fun. And so we still do that. We have a rental portfolio. We own the industrial parking lot. Clear Sky Financial, we have the hard money business. We have about 35 million on the street right now, soon to be 50. I'm in the process of trying to raise more money now. I didn't think we'd ever get there, but we're raising money now. We have a 506B fund and a 506C fund. Those are Regulation D funds. The C fund is to accredited investors only. The B fund, I can have some non-accredited, it's 35 to be exact. So we have the fund. A good story behind that is when, and all of our money was in Virginia at the time. Once we got over 10 million on the street, we were doing it in the form of 1-year promissory notes. Well, state of Virginia knocked on our door, state corporate commission. Hey, I see you guys have been in business for about 4 or 5 years on the hard money side. How are you guys set up? And so we're like, well, we have a lot of friends and family money. We're doing it by promissory notes. They give us money. We personally guarantee the promissory notes. We're giving them rate of return, right? Well, our investors were with us for over 5 years. And so even though our promissory notes by the letter of the law said a year, which you're allowed to do, they were like, are you renewing these notes every year? How is that working? And so we explained it to them. And they were like, you know what? We can, even though what you're doing isn't wrong, we can construe these as securities. I want to see every one of your wires for the last 5 years. I want to see every one of your transactions for the last 5 years. We're like, So then what we did, we're like, we need to change some things up. So then that's when we started the funds. So we were proactive about the state's approach, and we created the funds. And that's where the funds came from, was because of that situation. We were in the right, but we didn't want to go ahead and spend the legal money to fight the state, even though we've fought the government before under this thing called Clear Sky Holdings. We had Clear Sky Car Wash. So we fought the government on an eminent domain thing, and it took us 3 or 4 years. And that's where most of the money from Clear Sky Holdings came from. And Clear Sky Holdings does tax lien certificate investing. And that's another topic. That also does hard money. It's got some rentals. And then we own another commercial property in that. And that's basically who we are. Okay. So I've been around a minute. So tonight, what I'm going to talk about is I'm going to assume that you guys need money for fixing and flipping and for your buy and holds. That's what I'm going to assume. All right. So that takes me to another segue, is that I want to understand from you guys as investors, who are beginning investors? Raise your hands. Okay. 0 to 5, right? 0 to 5. Okay. Who are 5 to 10? And 5 to 10 could mean fix and flips. It could mean you've got a couple rental properties, or it could mean combination of both. 5 to 10? Nobody 5 to 10? Okay. I know you're advanced. I'm not. We know that. 10 plus? Yeah. Okay. All right. So we're good. So you guys are right. You guys are in the right spot. All right. So I'm going to talk about that. I'm not going to talk about transactional funding. I'm not going to talk about cross-collateralization funding. I'm not going to talk about lending on commercial properties where I care about the cap rate and the ROI and stuff, NOIs. I don't care. I'm not talking about that. Bob Hope once said, getting the money, a bank is a place that will lend you money if you can prove that you don't need it. Is that true? Is that true? It's true. It's very true. And I'll segue that into another story. So the community bank space is a very incestuous space. When we first started with our first fix and flip back in 2003, we bought a house pre-foreclosure. We really didn't have much money to buy it. And so we went to a community bank called Burke and Herbert. But the way we found Burke and Herbert is my partner, who's going to be here soon, went through the yellow pages. This is how long ago it was. So he goes through the yellow pages and he's looking up all these community banks, right? And Burke and Herbert being a B, he said, I'm going to call Burke and Herbert because the loan officer's name was Joe Collum. Well, his dad, Charlie Collum, was the chairman of the board of the bank. And so Sam figured out, he's like, okay, well, if this is Charlie's son, then Joe might have a little bit of pull and he can get us a loan. So we bought a house in Woodbridge, Virginia, 22192 on Salem Town Road. And I'm going to give you guys addresses because you can look us up and verify us because we need to be verified. And so we bought this pre-foreclosure. And what that means is a pre-foreclosure is a property that's going to go to foreclosure at the courthouse steps where they advertise it in the newspaper, but it hasn't gone to foreclosure yet, but you got to buy it before the auction and you got to buy it from the owner. So usually a lot of times that means you got to close in 2 weeks or less. And so we went to Burke and Herbert and we got what was called a fix and flip line. And the fix and flip line was, we had to put down a down payment of 25%. So they would fund 75%, but we had to carry the renovation. And so by looking through the yellow pages, that was our first bank relationship. And that's how that came about. And the reason why I say that is because even though I'm not talking about soft money or community banks, that's got to be a tool in your toolbox, community banks. And I was trying to explain that to you earlier. You have all those rentals, right? And you've got the normal HELOC for the normal big lending mortgages, right? Eventually, you're going to have to go into the community bank space because you're going to get too big. The normal mortgage companies are going to shut you down, and you're going to just have to get different relationships with different banks. All right. Now, finding the place when you don't need it. My story, I'll end it. The community bank is very incestuous. So what's going on with us now, as each time a bank either gets bought out or they're buying somebody out, all these different people are transferring to different banks, but they remember us. And so now us, we don't need the money, but banks are calling us all the time for our business, especially now with the looming bank crisis. All the community banks are starting to call us because they want our deposits, because they want to help capitalize with their looming problems on the B and C debt problem. So keep that in mind. All right, let's talk about the current economic environment. I'm not telling you guys something you probably don't already know. High inflationary environment. We hope the rates this is it, because inflation was very, very low this past month compared to last year. So we think the rate increases are done, but we're still in a high interest, well, not really high. I mean, for guys like me, this is still a low interest rate environment. I mean, I remember back in the days when interest rates were much higher than this. And I think the general public has gotten used to that actually, which is why this real estate market is absolutely berserk. They've raised rates 10 times. Recently, the most recent rate was a 0.25% increase. You'll hear BPS, right? So they did 4.75% increases. They did 2.5% increases, and they've done 4.25% increases. So they've been increasing the rate 5% in the last year, right? So for a lot of you newer investors, you're not used to this. Okay, we're used to it, but you guys probably aren't used to it. So it's just and so we're going to cover some things that are just a different way of thinking. That's all. 30-year mortgage back in November was 7%. Today I looked it up, it was like 6 7/8. Whatever, still kind of high. Housing has slowed in some markets. I'm going to explain this in a second. However, some markets still have multiple offers. So what you guys got to think about and realize is that this market is at its most granular form. You can't just say, oh, Maryland is trending this, DC is trending this, Virginia is trending this, Northern Virginia. You can't do it anymore. You've got to get down to the subdivision level, because there's certain subdivisions that are bullish. They have everything is under contract, everything is sold, no actives. That's a bullish subdivision. You have other subdivisions where you might have 4 actives, 4 under contracts, 4 solds within 120 days. That's a neutral subdivision, right? You got, similar inventory to similar under contracts. You have buyers there. Prices probably aren't going gangbusters. And then you've got subdevelopments that are bearish. You have 10 actives, maybe 1 under contract, and maybe 3 solds in the last 20 days. Well, those are subdivisions where there's price pressure. And this area has some, especially in Washington, D.C., especially in these higher crime neighborhoods, they have a lot of price pressure. These condo conversions, price pressure. The $800,000 to $1.2 million not in Petworth, in other parts of DC and Northeast, they're having price pressures. So you're having to drop prices to get your property sold. So remember, guys, it is a subdivision market. Why do you need to know that as investors? Because if you're buying fix and flips, when you're doing the ARV, you've got to know your subdivision where it's at. Because if it's a bullish subdivision and they're getting multiple offers, you're able to pay maybe a slightly higher price for it because you're going to be able to get a slightly higher exit. So you've got to know stuff like that. Office space availability, guys, let me tell you something. We're in for it. Would you agree? Yes. We're in for it. Stay tuned. Our friend, Mr. FDIC, they're very busy. And so when Silicon Valley Bank came out, they went under, as we all know. That started a domino effect, which we haven't really seen yet. But they put out a top 10 list of banks that they think are going to be consumed by FDIC. One of them was Sandy Spring. Y'all heard of Sandy Spring Bank? Yeah. They're in our area. Why is Sandy Spring on that list? Because Sandy Spring is holding a lot of Class B, Class C loans with investors on these office spaces that are maybe 45, 50% rented out right now. Leases are coming up. They have to be renegotiated. The credit boxes have changed for these banks. The people that own them, they have to refinance them because the credit box has changed. The interest rates have gone up. So what has to happen is they're going to have to write down those loans or maybe foreclose. But then in order to do that, they got to write them down and they got to recapitalize. And that's really a struggle for some of these banks, especially the community banks that doesn't have a high deposit. And we have, foreclosure filings are way up. Now, this is kind of a little misnomer here. The number of foreclosure filings being way up. They are way up, but the number of foreclosures actually getting to the courthouse steps is very minuscule. Most of the auctions are getting canceled for a lot of reasons. Number one, they can pop a sign in the front yard and get their house sold. Number two, a lot of investors are buying them as pre-foreclosures, which is a good way for you guys to maybe find and acquire properties. And so keep that in mind. We also have a low residential inventory in a lot of spaces, especially in Northern Virginia. Our market's nuts. And I know you out there, by the way, that's Sam. Everyone look, partner Sammy's late. So anyway, especially in Loudoun County, a lot of Fairfax counties, the inventory is really, really low. We're having a lot of multiple contracts. So you guys got to keep that in mind as well. Okay, now, money sources. What I'm going to focus on tonight is subject twos, DSCR loans, and of course, hard money. Okay. Remember, I did this presentation for regularriches.com, and they've got a product. They've got a 7-module product that they put out, and it was investing in recessionary times. That's what the product was supposed to be for, and they put it out about 6-7 months ago. But we're not really in a recession yet, at least not the housing market. but that's what the product's for. So it was talking about money sources, what you need to do in a downward trending market. Okay. So that's why you see a lot of lines crossed out, because I've got a lot more topics that we can cover. Like this one I kind of touched on briefly about the fix and flip line, the buy and hold line. We even have hard money lines with community banks. But that's another topic that you guys got to be aware of. So the first thing I'll talk about is subject to financing. Anybody know what subject to financing is? You know? Anybody else? I know you know. Oh, okay. Good. All right. Basically what it is, it's a property that's, you can buy a property subject to the existing financing. That's not the same thing as a loan assumption. Okay. VA and FHA offer loan assumptions, but you got to get qualified by the underlying bank. And anybody can get qualified for a VA assumption. I don't know if you guys knew that or not. You don't have to be in the VA to get a VA assumption. You just have to qualify for the bank, and they got to approve you, bring you on as the new borrower, let the old borrower off the hook. That's not what subject to is. Subject to is taking over is buying a property and taking over the existing mortgage. Okay. Now, you got to be careful, because in that scenario, the underlying servicer of the mortgage, the investor, doesn't know that you're taking it over, right? So you're sort of doing it, and they have what's called a due on sale clause if the deed transfers. So if they find out about it, but it's a very good method to buy properties, because in my experience, I don't know about your experience, but the number of subject to mortgages that I know of, how many of them have ever had a due on sale clause by the bank? I know zero. With the caveat that says you got to be timely on your payments. You got to carry the insurance. If it's a non-escrow loan, you got to make your property tax payments. Okay. So as long as you're doing the things that you're supposed to do as an investor, they're not going to call it, because the investor who's behind the servicer would much rather keep that mortgage instrument in place and receive timely payments than to put out a new mortgage. And then you guys are saying, well, that doesn't make any sense because interest rates are higher. Why the hell would they do that? They want to put out new mortgages at higher interest rates, but that's not the case, because they have these mortgages, especially these investors, they have these mortgages in their performing portfolio. They want to keep that portfolio as high as possible and keep it performing. They don't want to have the risk of putting out a new mortgage at 6% or 6.5% and have that mortgage default. They don't want that. They love the performing portfolio. Those are good assets. There's no formal bank approval process. Now, what you got to keep in mind, though, is that the owner that has recently sold the house, they're still on hook for that mortgage, right? The debt's underneath their name. But that's good and bad. And I'll explain it in a second. Most mortgages have due on sale clause. Purchaser incurs no liability to repay the loan. So they're not on the hook for it. But if they want to keep that house, they're on the hook for it. And a lot of times when you're buying subject twos, why are you buying them? You're buying them for two reasons. You're buying them because it has a much lower interest rate on it, right? And you want to cash flow it in your buy and hold, right? And I'll go over two examples. I'll go over an example of a buy and hold. And I'll go over an example of a flip example using subject twos. But that's why you want to do it, especially in the interest rate environments now, right? Remember I said, we're at 6 7/8, 30 years. But what has happened between the years 2019 to 2022, 23? What were the rates at? Come on, guys, we know. 2 7/8, 3%, 3.5%, right? So if you're buying a buy and hold property to invest, doesn't that sound like a good underlying mortgage to have? Right. So that's why these things are very popular, and they're going to become more popular as rates keep going up. Now, they would be a little bit more popular now if we were in a little bit more of a distressed marketplace as far as residential real estate is concerned. We're not really there yet. And so once the market turns a little bit, if it does, then this will be a good way to acquire properties, is using the subject twos. Okay. Another thing that we do is we do what's called a power of attorney. Okay. When you're the buyer buying the property on a subject to, remember, your name isn't on the mortgage with the servicer. So what has to happen is a power of attorney should be drawn up. I'm saying it should because not all title companies do this, but a power of attorney needs to be drawn up so that you, the buyer, has a limited power of attorney over that mortgage, so you can speak on behalf of the person's name that it was in, so you can get information on it, right? So in case you go to sell the house or whatever you want to do, you got to be able to get information in case you need it. We also do it for the homeowners association, the hazardous insurance. If you're keeping the existing tenant in place, you might want to do that. And then once the lease comes up, then you just simply put the lease in your name, or you can do an addendum to the lease. But if you don't do these things and you just want the tenant to keep paying you rent, and sometimes maybe you don't even want them to know who you are, that's not a bad way to do it. Any questions so far?
I don't know if this time we're going to ask the question, but what would make a person want to do that if their name is still on the mortgage?
During foreclosure? They're in some sort of distress scenario. The other way is, remember, we were talking about 3 different subdivisions, right? We were talking about the appreciating subdivision, the neutral, and the depreciation. Remember, there are some subdevelopments where prices are going down. And so if a realtor is selling the house, that could be a good tool for them to use in their toolbox to get that house sold. Right? Remember, not now, because we're not in a overall tough economy, right? Certain areas might be just downward trending, other areas are not. So, right. But usually it's a pre-foreclosure.
So are you paying the seller directly and they pay into the escrow account?
Yeah, you have a normal closing, right? You'll have a normal closing with a title company that does. I would stress, go to a title company that has experience with subject twos. So you go through a normal closing, like you'll have a normal deed transfer, but the purchase price is the subject to amount, right? Because you'll know the payoff amount, sort of. And then it's, if you need to bring any money to the arrearages, if there are, and then the down payment to the seller, whatever it is. And then that's your purchase price. Those 3 things added up. So it's sort of a normal closing, but that's what constitutes the purchase price.
And it doesn't alert the existing lender or anything like that if you change the account information or the name of the account that's paying into the servicing company?
You're not changing the name.
So if I'm buying a house from you and it's your loan, I pay you every month?
Nope.
You pay me?
Nope, you pay the servicer directly.
Okay.
My name's still on the loan though.
Yeah.
My name will be on that loan until it's retired. And that's the other thing that has to happen is that, obviously we're licensed. We have to disclose. The same thing is when you're closing. There's usually also another 1 or 2 page document done between the buyer and the seller, because it's very, very critical that the seller understands where they are. They have to understand that they're still on that loan. But remember though, it's all about the motivation of the seller. This isn't like a normal retail deal here, right? This is a motivated seller. And so that's why you're doing this. Like I said, it's just another tool that you can use to do this, right? It's all about the motivated seller. House is vacant, house is blighted, house is pre-foreclosure. There's a lot of different ways for motivated sellers these days. Divorce. Usually it's a life-changing event. That's what we always say. It's a death, it's a divorce. It's, you just never know. So, but it's all about the motivation of the seller. That's why these things work. All right. Here's a deal that we did. It's in Ribblebrook Drive, Culpeper, Virginia. Single family house, 3 bedrooms, 2 baths, 1998 built. The house was in pre-foreclosure. All right. Check. It was vacant. Check. Which means out of town. Well, in this case, it was an out of town owner, New Jersey. Check. So it checked a lot of the motivated seller boxes. The original loan was a VHDA loan. You guys know what that is, VHDA? Okay. FHA, we know what FHA is? Okay. So all VHDA is similar to an FHA loan, but it's a Virginia first-time homebuyer program. VHDA. V stands for Virginia. Housing Development Authority. It's a Virginia thing. Okay, that's what VHDA is. So the VHDA loan, so it was a government-sponsored loan, right? The loan origination date was December 30, 2015. And the other benefits of Subject 2, guys, is that you're also getting the benefit of buying into the AM schedule. So this loan was originated 8 years ago, 3.75%. Now, the arrearages was $44,000 too. It was a pre-foreclosure, so they were late on their payments year and a half, 2 years. Plus you have trustee sale, you have the lawyer fees, you got to be published in the news. They were published in the newspapers. You got publication fees. So you had all kinds of fees just getting jacked up, default fees to the lenders. All these fees added up. So this guy was behind $44,002. The original loan amount was $192,500. Okay. So then what happened was we met the owner in New Jersey, gave him, we didn't even do this one through a title company, gave him a cashier check for $10,000, right? Because when you're buying something as a distressed asset from a seller, you got to give the seller some kind of incentive. I mean, it's going to go to foreclosure. He might not have gotten much. So gave him $10,000, then wired $44,002 to the substitute trustee that was handling the foreclosure sale, right? And then it's just subject to the existing financing. So basically, the down payment, $54,002. He still got $192,500 left on the loan, right? Because that's what the balance of it was a couple years ago when we bought it. So the total purchase price, $246,502. Now, beautiful thing is, after repair value was $375, not bad. But what I'm not telling you is that it was, remember, I said the house has been vacant. It had been vacant for about a year. So it's actually $246,502 plus some more money out of your pocket to get it rental ready. But it wasn't a very old house. 1998, it was only one level. It was in pretty good shape. Okay, so then I think another $15,000, $20,000 was spent. The PITI payment, $1,365, rent payment, $1,950, positive cash flow, $585. You guys would take that deal, right? All day and Sunday. So not only are they in about $100,000 equity position, they're also $585 positive on a loan, wrong one, on a loan that started in 2015. Come on, guys. For what? Almost 8 years into the AM schedule. Now we got 22 years left at 3.75. So I would say that was a pretty good deal. All right, next one, wrong way. The next one is where this particular person used a subject to, this is a fix and flip. So they used the subject to do a fix and flip with a hard money loan second. Okay, so figure that out. Subject to, they bought it. Hard money loan, fix and flip. The hard money loan was the second trust, provided the down payment plus the renovation. So this person's in the deal with no money, maybe a little bit of money. This one was an N-unit, 2-level townhouse, Dale City, 4 bedrooms, 2 full baths, 2 half baths, 1968 built, but cookie cutter subdivision. So it was easy to pull comps for us. We were the hard money lender on it, second trust position. Actually, this guy did 3 of these houses at the same exact time. Renovation budget was up $50,000. Original loan was $133,000. Origination date was back in 2013. So the current loan amount was $120,000. This was a couple of years ago. So what he did, purchase price $168,000. Remember, $120,000 was the loan balance. Cash to sellers, $48,000. After repair values, $295,000. We put a $75,000 second trust on top of it, and then they flipped it out at $293,000. So they made a pretty good chunk of change. Now, what we did though, once the deed was transferred to their name after the subject to, we then could put a second lien in place underneath the new owner. So so the second trust is with the new owner, right? $75,000 each, $75,000. The first trust, it still has a balance of $120,000, but remember, that's subject to, so it's with a different lender and a different person's name on the loan. But because once the deed transferred, they own the house, we put a second on it because we didn't feel like there was much risk. And so then they flipped out of it. Okay?
Trust was just like a second position?
Yeah.
Okay.
I'm sorry. So Virginia, there's 2 different types of states. Deed of trust states and there's a mortgage state. Virginia, California, They're all deed of trust states. Maryland, DC are mortgage states, right? I mean, I don't know if they consider mortgage states.
I mean,
They are, right?
it's separating.
Right. And then they've got, and then they got judicial approval of their foreclosure auctions.
So you're saying the process by which the full
Process is a little different.
process is different.
Yeah.
So that is a distinction rather than a label.
Right. So they're deed of trust states too. And then, I know Pennsylvania's a mortgage state. But yeah, so you just got to be familiar. And all that means is it's the same thing, but it's just differences in the laws. So you just got to understand the laws of whatever jurisdiction that you guys are doing. You got to know the laws. Like Kansas City, right? Hawaii, right? We're in Maryland, DC, Virginia, North Carolina, Florida. So for us on the hard money side, we have different loan docs in each jurisdiction. We have different lawyers in each jurisdiction. We have different default language in each jurisdiction, right? So it all depends. All right, so that's that. Okay, now, subject to deals. You guys know the advantages, right? Pretty obvious. Interest rate, that's why you're buying it. Terms of the existing note. No application documentation, no credit check, right? You're not getting approved by anybody. Minimal down payment, because all that's negotiable. You're buying it directly from the seller, so you negotiate what you want, because, 9 times out of 10, you need to find it distressed properties. Further into the AM schedule, which is good. Disadvantages, bank can recall a loan on the ownership change. Former owner is still on hook for the obligation. That's not your disadvantage. It's a disadvantage. Okay, so one of the things that we talked about is that there is a company out there, and it's not an insurance company. There's a company out there, it's Assurance, ASSURANC. They will assure, you pay them a fee. We need to own that company. It's the best company. You pay them a fee, and and if a bank ever recalls the loan, they will assure that they will pay it off. But you got to pay them. You got to pay them a fee. It's not insurance because it's not regulated. It's assurance. All right. How to find them? Remember, you guys got to keep adding to your how to find them list. Pre-foreclosure ads, out-of-town owners, realtor referrals, right? Because some realtors are going to start maybe doing this. Subject to mailers, right? And so, we're old-fashioned. We still like the mailer strategy of finding, but we don't like to buy lists. We like to create our own lists, because you creating your own list is a data that's inherent to you, and that's the most powerful form, right? If you own your own data, you control your own data, you're kind of king of the hill, so that's what you want to do. But you got to focus on lists where the mortgage originations were between March 2019 and March 2022, right? That's a good 3-year window. I mean, you can go to other points in time, but I think that's probably not a bad time to start, because rates were pretty much under 4%. So I do that. One of our famous things that we like to do is driving for dollars. Remember, I talked about this, vacants and blighteds. But you got to keep building your list. Keep building your list. Keep marketing to your list. We triangulate, right? Phone calls, texts, email campaigns, mail, old-fashioned yellow card campaigns. Just keep hitting them. And so you could do a title search on the origination date of the loans if you find various vacants and blighteds. Okay. Now, once you do a title search, though, it's going to come up with the origination date of the loan, but not necessarily the interest rate. Some deeds of trust that certain lenders do, they'll all have the AM schedule. They'll all have a 30-year AM or 15-year AM or 20-year, whatever. But some have the interest rate on the deed of trust in the public filings. Some don't. So you just got to do a little more research on the ones that don't. Okay, that's subject twos. Am I doing it right on time, or am I going to? All right, I'll go fast.
Great.
DSCR, debt service coverage ratio loans. Basically what these are these are loans for buy and hold investors, where you have the property, it's been rented out, it's been fixed, it's renovated, and it's been rented out. It doesn't have to be renovated, as long as it's rented out. The income of the property is the key qualifier. So the property's income stands on its own. Debt service coverage ratio. Okay. So if you got a property that's renting out for $2,500, a lot of the banks like to see the payment at $2,000. Then you go through the approval process. They're not as stringent. It's pretty much it's an investor loan. Usually it's LLC. I don't know that they'll do it to your personal name. That's for other 30-year mortgages. And so you have to have an LLC. Sometimes 20 to 25% down payment. But remember, if you buy a distressed property that you want to buy and hold, the way to do it, you get it at a good discount, put some renovation dollars in there, you get a renter in there, right? So you've come up with very little dollars of your own. Once the property has been seasoned for 6 months, right? Then you go get a stepped up appraisal, then you get into your DSCR loan. Okay. Right now, you need at least a 660 credit score or higher. It might be at 640 now, I'd have to check, but last time I checked, it was at 660. So they'll check your credit. But you can pick your AM schedule, which that's nice, 30, 25, 20. And the other thing I was talking about earlier is that multiple loans, there's no maximum number of loans. Remember, it's all about the property. Kind of like hard money, we're asset-based lenders. Same thing, except they're asset-based lenders with a cash flow caveat. That's the difference. DSCR calculation, it's the property rents, right, over PI, right, principal, interest, taxes, insurance, and association dues. So if you're in a condo association, HOA will come to play. So for example, 2,500 rents, $2,000 payment to 1.25 debt service coverage ratio. The higher that ratio is, the lower the interest rate is. So if you're tight on it, right, let's say it's 1-to-1, they're going to stick you with a higher interest rate. So the higher the DSCR, the lower the interest rate. So you got to keep that in mind. But it's a good vehicle to use to accumulate a lot of rentals. Now the interest rate's going to be a little higher, but money out of your pocket could be a little bit lower if you do it the right way. You know, so one of the ways.
How are you calculating the DTI if you don't have the loan yet?
Oh, because they're calculating it based on what the payment will be with a certain interest rate. And then they do it that way. Yeah, that's a good question. Yeah. Advantages, flexibility, multiple loans, multiple properties. There's no 10 loan limit, right? 20 loan limit. I don't know what the maximum number of, like I can't even walk into a bank and get a loan. It's not a mortgage. It's got too many in my name. We can walk to a community bank and get millions and millions of dollars credit lines, but I can't get a normal mortgage. Flexible AM schedule, which is nice. Interest rates. Disadvantages could be the interest rate. They're going to be a little bit higher. If you go to your community bank and get a rental line, they're going to be a little bit lower probably. And then you do have a credit score requirement. So it's not as simple as hard money.
So then are you buying the original property with hard money or something else and then waiting a certain amount of time, refi into one of those?
I'm not saying that, but I'm saying that.
And is there a certain amount of time that you need to have a renter in there? Like, do they need a certain duration of income?
No, but you're going to need to own it. It depends on so one of the things you got to understand is all sizes don't fit. So different DSCR lenders will have different underwriting criteria. Some might allow you to do a stepped up appraisal in 3 months. Some might make you wait 6 months in a day. They all have their different requirements. So what I would suggest to you is just understand what their process is and what their underwriting requirements are and what they do, how flexible they are. Because this is a pretty good product that's out there these days. And a lot of investors on the other side of these servicers like it because they're getting a higher return on their money, right? Because just because you see a lender, right? Let's say you have a servicer. You guys all understand that if your servicer, let's say it's SPS, specialized lending or whatever, they're just a servicer. They're not the underlying investor. You don't know who that underlying investor is, right? So what happens is all these big mortgage companies have a pool full of money, right? And that's their pooled mortgage fund. And that is the investor. And so with these DSCR products, they're a higher returning vehicle on the pooled mortgage fund. So
Starting shopping around for those then, before from criteria and rates and everything before you,
I'd probably shop 2.
so that you know what you're
I'd shop 2 or 3. The thing about it is, though, there's just not that many people. Remember, this is a very specialized thing. So there's just not that many DSCR lenders. A lot of times you might go to a loan broker who might have 3 outlets, DSCR outlets. That's probably the place I would start. I mean, you certainly can figure out 3 different DSCR lenders on your own and make all these phone calls, but you might want to start with a loan broker to let them do all that legwork, because they're going to know the answers to your questions, so you don't have to do that. All right, good? All right, hard money. I'm going faster.
Yeah.
All right. Hard money lending, it has a bad connotation. Hard money, it's just like a used car salesman. What hard money means is that you're lending on the hard asset. The asset stands up on its own. There are no credit checks. In our case, there are no applications. There are no credit checks. It's all about the underlying deal. You send a deal in, we say how much we're going to loan against it. It's that simple. Is it a fix and flip? Is it a buy and hold? Is it a wholesaler where we need transactional funding, cross-collateralization? Just tell me the asset and just tell me the details of the asset, and it's that simple. It's a short-term loan. We use the after repair value of the property when determining the loan. We also use this thing called a loan to cost. How much are you buying it for, and then how much is the renovation? And we do some number crunching there. So we've got 2 parameters, LTV of the after repair value, and then this thing called a loan to cost. Put those things together and we say, we will loan this much. We're not as concerned with the creditworthiness of the borrower. I'll caveat that in a second. Few, if any, income restrictions. So I'm going to ask Sam a question. How many applications have we ever done in 11 years?
Oh, wow. 1,000. 1,000 deals, 0 application.
Okay. How many credit checks have we done?
0.
Okay. How many tax returns have we received? Right.
0.
So that's right. Now, the downside is that you're going to pay a little bit higher interest rate. Like anything else, it's a tool in your toolbox. You got to know how to use the hard money guys to your advantage. And a lot of smart investors do. They use this for leverage. They use this for timeliness. They just use this to make the money. But they can execute. They're in and out. Okay. Now, we do care about credit if your exit strategy is, I am a buy and hold investor, and I'm going to either refinance you out with whatever, a DSCR loan or a normal mortgage or whatever. Then we care about credit at that point, because we want to know about your ability to be able to close in that refi. Now, we don't pull a credit report. It's just like what's your credit score? 720? No problem. What is it, right? It's that. Really, it's that. And so remember, you're getting a property at a good deal. So we'll deal with your credit score issue in 6 or 7 months. Hopefully you didn't lie to me. Maybe you did. Hopefully you didn't. But if you did, we'll deal with it then. But that's not good, right? Because if you're lying to me at the very beginning of our relationship, that's not so good. So that's kind of how we do things. Pretty simple, really. Hard money loan types. It's for fix and flip loans. We have fix and flip renovate loans. Matter of fact, most of our loans are fix, flip, and renovate loans. So we pay the renovation on the property and we do it in the form of draw schedules. Buy and hold loans. We have bridge gap funding, transactional funding. What that is you guys are familiar with wholesaling? All you guys? Okay. What transactional funding is you're a wholesaler. You're making a $70,000 assignment fee, but you don't want your seller to know it because that might blow your deal. So then what you just do is you do a double close. You have your cash buyer, right? You buy the house, transactional loan. So we'll fund 100% of that. You close it. You then sell it to your cash buyer at another closing, 24 hours or less. But we've had transactional loans that have lasted a couple of weeks, right? And so for us, when it's a transactional loan, even though you're the wholesaler, we're giving you the money, we do have you sign a deed of trust and a promissory note, but we won't record that deed of trust. We won't record it at all because supposedly you're wholesaling it to a cash buyer in 24 hours or less. So Our money goes out, it comes back. So we're trying to save you some recording fees. But we don't record it. We might record it 2 weeks later if the transaction gets nixed. LLC purchasing, why is that a big deal? Not a big deal right now, but it might be a big deal. Let's say you're buying a short sale under an LLC. Bank has approved it, right? You're about ready to go to closing. You can't, let's say you had such a good price on it, bank's approved it. You can't wholesale it to another buyer. You can't change the name of the buyer. But what you can do is continue to buy it into the LLC and then just simply assign and sell the LLC. Then have the new buyer come and buy it. That's how you can wholesale a short sale. Right, because you can't get a new buyer on there because the bank will have to go through another approval process. And if the market happens to go up a little bit during the short sale, they might have to get a new appraisal and they might turn your short sale down. So that's another way. We've done a bunch of those. And then multi-collateral loans. Okay, so those are the loan types. Why do you need hard money? Because people are like, oh my God, you charge 12 and 12%, 3 points interest only. I'm not paying those interest rates. You're full of crap. You need cash, right? Most time people come to us is because they need to close in a week or less, or they've leveraged out their business, or they want a bigger return on their investment cash-wise. Because remember, we are fully leveraging you as much as we feel comfortable with. So a lot of times you're not coming up with that much cash out of your pocket. And so that's another advantage. You have bad credit? Most of our guys do. They have bad credit. We don't even ask. We don't care. Further leveraging of your business. And then of course, the most popular phrase in America, right? Other people's money. That's why people use us. And then we just, it's like, they use us. It's sort of like, even though it's a normal lender-borrower relationship, even though they're borrowing money, they're basically renting our money. That's what it is. It's just a big money rental. That's what it is. They're renting our money. It's all short-term. Hard money versus other lending types. We typically do not lend on primary residences because of certain laws, TRID being one of them, the full disclosure stuff to a consumer. So we try and stay out of the consumer world. We're a business-to-business lender. Caveat, we do it.
Not directly.
Not directly. How do we do it? In Virginia, a lawyer can originate loans. I don't know if you guys knew that or not. As long as you're in the Virginia bar, you can originate loans. So we do, if it's somebody who needs a close, and some of the realtors got smart because they used hard money quite a bit, because if you're working in a multi-contract scenario and you want your buyer to buy the house and they have cash, caveat, they have to have cash. They used us and their borrower would put down 30% down payment because they got to get the house, and they would put in that contract, oh, we'll close in a week. Don't you think that would probably move you to the top of the list? You have a non-contingent finance deal, and you're going to close in a week. That's going to move up to the top of the list. So then you just compare that offer against other, if you're a good realtor, you compare that offer against other cash offers. So a lot of realtors used us in that fashion. They had 30%, they had good quality. They came, they closed with us, they got their house, they were all happy, right? They got a hard money loan for maybe a month, refinanced the style, boom. But we originated it through a lawyer in Virginia, and we avoided TRID, and then they closed, refinanced us out. Now in Maryland, we can't do owner-occupied house loans in DC because we don't take personal guarantees in DC, so we do not do that. In Maryland, there's a law that says if you're a broker, I told him I own 50%. You know I'm not a broker. As long as you sign something that says, I agree to use this brokerage within 2 years for any real estate transaction, then the broker in Maryland can originate the loan. Yeah. So that's how we do it in Maryland, if we have to do an owner-occupied loan. We try to avoid them.
Helps them buy or sell in those 2 years.
Or it's great. Right. Yeah. That's how we get around that legally. So we don't do anything illegally. We stay out of court if we can. We do not sell loans. We've serviced every loan that we've gotten in. We've never sold a loan. I've had a lot of people, I got people call me all the time, do you want to sell loans? And so we service everything. So we have that investor from day one, all the way through their project until they sell it. And, oh, by the way, whatever help they need, they can call us for anything, advice on anything. How to manage the contractor, how to get quotes, what contractor should I use? We're along with them whatever they need. Do you have this? Do you have that? And so anything that they need, because it's more than just a lender-borrower relationships, because we're trying to get these guys to be repeaters. So the better and faster they can execute and make their money, right? They're going to come back to us over and over and over again. And it happens. Short-term loans, I don't know about the 18-month part. Most of our loans are 12 months or less. Virginia, we're running 6-7-month loans, because if you're fixing and flipping in Virginia, you better be out in 120 days. 150 max, or else you got an overpriced asset, or your work is terrible. That's it, because that house should not be on the market. Maryland, 9-month loans. DC, everything goes up to about a year, because in DC, if you're doing a full gut renovation in Petworth, row home built in 1910, 3 levels, it's going to cost you about $180,000 to renovate it. That's going to take a minute. Okay, and so we'll go a year in DC. We all have customized lending criteria. Basically, the criteria is call me up, send me a deal, I say yes or no, and that's that. There you go. I'm the underwriter. And then I stick him with all the problems. Right? That's it. We can close in 24 hours. Caveat to that is, as long as the title company has pulled the title binder and the title work is good and they can insure it, and it's already there, we'll do it under 24 hours. Usually that's because somebody calls me up and says, oh, I had another deal. This deal was supposed to close on such and such. My hard money lender pulled out, or such and such lender pulled out, but I've got to close it tomorrow and it's a great deal. Will you do it? And as long as it meets our criteria, the answer is always yes. We'll do it. So we've done a bunch of stuff in 24 hours or less. It's an asset-based loan, guys. No credit, no income. What borrowers need to know? You guys have got to know your after repair value. You have to. I'm going to do it. And we're going to have the meeting of the minds. We've got to be on the same page. And a lot of times, sometimes we're not. I had somebody bought a house on auction.com in, I don't even know where today. It was a 1930 farmhouse. She sends me this text, oh, I need a loan for such and such and such. I bought this house on auction.com. I paid the 5% auction.com premium. I've got it worth $450. Okay, sounds good. So I go to the MLS. Oh, it's a farmhouse built in 1930 in Charles County, on well and septic, and it's vacant. My comps are showing maybe $350. First of all, I couldn't comp that because it's so hard. How many 1930 farmhouses are there? She goes $450. I said, oh no, $350. And oh, by the way, she's buying it for $272. I'm like, honey, that's a bad deal. That's not something we want to do. So that kind of stuff happens all the time. So you've got to know your ARV. So right then and there, we probably got started off on the wrong foot, because I'm helping her, because now she's freaking out on me and saying, what do I do? What do I do? What do I do? And so we're going to help her get out of this deal and save her money and move on to the next one, because that is not a good deal for this person. And so that's part of what we provide. So you've got to know your after repair value. And if you don't know, we're going to help you. Project budget, right? You got to know your renovation costs, guys. Send me some pictures. Send him some pictures. Let us see it. Don't tell me a house in Petworth that's vacant and needs everything is going to cost you $50,000. I can't tell you how many times that happens. All the time. I got somebody buying a house in Dale City right now. We agree on the ARV. It's worth $440. The house was built in 1974 and had been rented out for however many years. Their renovation is $30,000. That thing's going to cost them $70,000 or $80,000 all day. So you got to be realistic. And we're okay. We're going to help make you realistic if you're not realistic. But that's part of building the relationship. And sometimes people get mad at me. And so they get mad at me because whatever. And then they go and try another experience with another lender. Then they have another bad experience. And then they realize that they actually love me a lot more than they thought they did. And then they come back, and that's how we build our trust. Because a trust is a two-way street. You got to have a good contractor. If you don't have a good contractor, guys, we'll help you in Maryland, DC, and Virginia. So if you
Requirements to self-perform.
would say,
Self-perform.
Yeah.
Requirements.
yeah, we like it better when you use our contractor, because let's say you had a $100,000 renovation, and it's 5 draws of 20. The same investor used the same contractor. to fix and flip houses, about 50, 60, 70 of them, the work was absolutely terrible, right? And you're thinking, well, how is Berger Herbert in trouble? Well, even though they lent on it, they were supposed to make sure the work was done right, and they lost a lot of money in that lawsuit because they sued the biggest, right? Who gets sued? Everybody, but who has to pay? Whoever has the most money. And so they got burned. And you also got to insure your profit margin, right? We're going to insure it for you, right? And so because we want you to make all the money, and we got to make sure you can execute, because the quicker you execute, the less money you pay us in holding costs, the more money you make, right? What do borrowers need to have? You need to have an LLC in good standing, right? Because we're pretty much a business lender. Hazard liability insurance on the house, or on the mortgagee clause, and lender's title policy. That's it. And of course, a good deal. Advantages, the leverage, obviously, guys. We'll go 100% loan to cost if the deal has enough room in it. So you'll get all that. Flexibility, speed to close. It's an asset-based loan. Remember, we lend on the spread of the deal. That's how we calculate our risk level, because, we fix and flip so many houses that we're used to the underlying asset. So in case we got to grab it back, we'll go ahead and execute on it. Not that we want to, we will, but that's not our game. Disadvantages, guys: high interest rates, points, shorter terms. That's it for hard money. Last thing I want to cover is, what do you need to do now in case we get into this recession, pre-recession actions? Understand your liquidity as investors. I always say there's three things you got to do as investors. You got to know your income statement. So if you guys aren't doing income statements, it's your budget income statement, know that. But you got to know it from a active income standpoint to a passive residual standpoint, because eventually your passive residual income, you want it to beat your active income so you can be financially free, right? So balance sheet, income statement, balance sheet. Next thing, like I said, liquidity. You guys know what that is?
Yeah.
What?
No.
Okay.
Wait.
If you were going to buy a house tomorrow, how much cash can you accumulate to close on that house tomorrow? Being cash, HELOCs availability, credit line availability, brokerage account lines of credit, fans of ability to raise money for friends and family. It's all the money that you can, within a week, that you can close on that property or close on that asset, right? That's what your liquidity is. And so you should keep track of it, well, quarterly at least, at a minimum quarterly. I keep track of it every quarter. On our business, we keep track of it weekly, especially on the hard money side. We've got to keep track of our liquidity daily usually, but mainly weekly, because we have such a high demand. We got to know what's going out, what's coming in, how much money we need to raise. Like I said, I was telling you, we did 16 loans in April, $5.5 million, 2 guys. Multiply that by 12, right? And we don't have that kind of money. We're probably divided by 2. We're at about 35. But if I need 60 million a year, I got to raise some money. But that's kind of liquidity. Maintain good credit. Can't tell you the advantages of that. As you're maintaining your credit, though, I would continue to build up your credit lines, but use it wisely. Don't, it's not to spend, right? Be smart about it. Increase your borrowing power. Make sure you got good reserves. Loan products are changing. I say during a recession, but they're already changing now. They've got 2-1 buy downs. I haven't seen a 3-2-1 buy down yet. I've seen 2-1 buy downs. You guys know what that is? So in a 30-year loan, 2-1 buy down is your interest rate on the first year. Let's say the interest rate's 6.5%. It's a 30-year AM. First year, the interest rate's at 4.5%. Second year, 5.5%. And then year 3 through 30 at 6.5%. That's a 2-1 buy down. 3-2-1 buy down is a similar thing. But these kind of products they started to come out because of the higher interest rates to get somebody who can't qualify for a house. They kind of, shoehorn them into the house, thinking that their income will go up, that they'll be able to afford increased payments down the line. You'll see 1, 3, 7-year ARMs come back. ARM stands for adjustable rate mortgage. So those products are going to start coming back. And then also too, if you buy a fix and flip, you got to have multiple exit strategies. So if the market does have a 10% correction, you got to be able to rent it out. Some of our worst flips are best rentals. I mean, we've kept a lot of rentals because the market has changed during the time that we thought we could get money for fix and flips. So we just kept us rentals. So now they're the best buys we've ever made, right? So have multiple exit strategies. And that's pretty much it. That's it. So that's me. Yep. Not so bad. Yep. So you guys got any questions?
What assurances, I guess, for yourself you being into the deal are subject to? Like if they do on deal funds, if that note was called due by the bank, what can you do to make sure that you don't lose the property?
Refinance it. You've got to be in the position to refinance it if that were to happen. I would probably reach out though. Really what I would also do, I would find out who that underlying investor is, and I would reach out to them to see if you can buy that note from them or have somebody buy it. That's what the assurance companies do. They find out who the investor is, and if the due on sale is called, they'll buy the note and keep it themselves. Because remember, they're charging everybody all these premiums. So you would need to make sure that you were in a spot to refinance it.
So I thought like a lot of the time, one of the benefits is that you don't necessarily need to be able to qualify for the loan. So if you're worried too,
Yeah, that's not so good. Yeah, that might be a problem. Do you have any ideas of that?
Once you have too many mortgages in your name,
No, she's saying, let's say
or you're on
you own the house subject to
qualify.
due on sale clause happens. You have bad credit, then well, of course, you'd have to probably reach out to somebody like us, hard money lender, because
I mean,
go ahead.
You can temporarily, if you have a good relationship with the seller, transfer back into the name. You stop the due on sale.
Huh?
Have a better scenario.
Oh, that's interesting. Oh, okay. Okay.
But
Yeah.
if you had to,
I like it.
if you really have to get down to it,
I like it.
might come to that.
Wow.
Yeah.
I like it.
Wow. I mean, I think that if you bought into equity and it's been a while,
Yeah.
though, you could probably get a hard money loan. Bridget, you could figure out
Community bank.
it's that strategy, perhaps sell it,
Community bank.
transfer it to a family member.
Community bank.
Fine.
In theory, you're helping the sellers in a situation. Third, you're thinking about here's a scenario. You can
Yeah.
pretty agree to some things that include this happens on the road.
That's a good idea.
Past that we're going to work through.
Yeah, it's nice.
Yeah, it's great. Yeah. Yeah. I mean,
Just one.
remember we talked about earlier, right? The power of attorney, one thing, and then that 2 or 3 page agreement that should be made between you and the seller anyway that defines the fact that they're still liable for that loan. Yeah, add some other points in there.
yeah,
You also transfer prior to the sale of the seller transfer create a trust in their name.
Yeah.
And so, and then until you service it to a trust name, it's a little bit easier. You don't have that
Yeah.
kind of point. There's as much as fishing.
Yep.
So it's a risk, but it's not a very common risk that like see if you're banks don't do it once.
Well, yeah, because the servicer doesn't even care, right? As long as if they can just collect the payments and get their little spread. So if they happen to run into a different name, they're like, whatever, especially for.
I think most one thing, something to write into the agreement to instruct the seller. You're really like, hey, you want to leave you okay? I know that you're taking all this risk in abandoning me, but if we break everything into your original sale day, if they do come into do then 1 year, breathe off in the purchase price, you got frequently. The original agreement is their profit, but then
Keep it as an agenda, so it's not in the contract itself. Something that was sent to their
Yeah. I mean, the other thing you got to realize is you're helping the seller out too. Because like I said, most times this is a stress situation. So they got dinged up credit. Like for one example, in Culpeper, that guy was getting foreclosed on. So now the loan's been paid for a few years and now his credit's getting better. So you got to remember that too.
And we said, how do you deal with the taxes and insurance things?
Well, most of these loans are PITI. So you just got to make sure that W-2 is coming your way though. I mean, the 1090 was it?
You can log in.
Yeah.
I mean, if you have all the login information, you can get all the information you need.
Yeah.
So you just keep everything that's for account and pay taxes, insurance, existence.
Yeah, I would. I'd keep it. I'll keep it going that way. What you do though need
Well, the insurance.
the insurance. You need to put the insurance in your name.
They never care. They don't seem to.
Yeah, you got to put the insurance in your name.
Someone else's name is on the insurance.
Take their name off. Get that name off.
Sale.
Yes, you got to put the insurance in your name.
Do all kinds of things with insurance. Things doesn't have to be the deed holder.
But
Yep. So we have so on the subject, I got a good subject 2 story for you. One, we had a guy working for us. He was a retired Fannie Mae executive, and he was working with us for a year or 2. And I put out a newsletter. This was, how many years ago? Was it 6, 7 years ago? I put in newsletters because we do a monthly newsletter for our hard money investors. So I put a newsletter talking about subject to financing. And so he worked for Fannie Mae during the 2007, 8, 9 cycle, the bad cycle. And he was doing a lot of loan modifications, HAMP, right? And I put that subject to in our newsletter. And I talked about the due on sale clause. And I talked about how the bank didn't know about it. He got so mad at me because, and he got so mad because I was so dishonest in the newsletter, and that how can you tell people to do something like that? That is so immorally wrong and dishonest. And he gave me a whole ration of, you know what? And oh man, I felt bad, but he was such a nice guy. But yeah.
Well, the hunk one has a due on sale section of, right? So when you go to every closing you've ever had, there's a subject to. In fact, there's a subject to line. You don't for that. So it's always been built into everything you do. You just stop.
Right. So yeah. All right. Anything else?
like, what type of experience with you saying that people in order to one live here? So first time.
None.
Well,
Okay.
you have to have a good deal.
Yeah, we're not. See, the thing is, it's good and bad, right? We're not that big. I don't think that we would, even if we were that big, I don't think that we would ever care, because we feel that we love new investors, because new investors are only new for 10 minutes, right? When you're going to all these meetups and you're learning as much as you can, and you do that one deal, you will learn so much more off that one deal than anything you've ever learned at meetups, because what you're doing is you're reinforcing your knowledge. And so we love to, it's part, like I said, it's part of the journey. It's part of the relationships. And your one deal is going to turn into 10 or 20 if you do it right. Now, if you do it wrong, you're going to hate me. You're never going to come back and see us again. Which brings me to another story, if you guys have time for it. At the very beginning of our hard money days, we had a set of investors that were killing in Charles County. They had their niche. They were doing the two in Barrister Woods and all those places out there in St. Charles County. 2-level townhouses, 3 bedrooms, 2.5 baths. They were picking them up at $85,000 and flipping them for $180,000, and they did $30,000 work, right? So they did 6 deals in a year, made good money, right? Then the next year started, and they brought us 6 deals in a month. I said, okay. So I know y'all want to do better this year, but I guess we'll do the 6 deals. Bad move, because these guys, we choked them out. We gave them the money for all 6 deals. They couldn't handle all 6 deals because they weren't good enough managing their crews. They didn't have enough crews to do 6 deals at once. And we literally choked them out. They fixed and flipped 4 of them. We had to take 3 of them or 4, I don't remember. We had to take back 2 of them because 6, 7, 8, 9 months went by. They stopped making us payments, even though they were flipping the other ones, but they got choked. The one house, because they had so many houses, they didn't even go to the one house where the power was out and the sump pump battery died, and the house got filled with a foot of water. Winter came to spring came to beginning of summer. We had a mold box. Oh, by the way, with a storage tank, right?
Storage tank and a condemnation from them. We can't leave because they can solve them all. That took a minute.
But it was our fault too.
Sure.
It wasn't their fault too. It was our fault. We allowed them to be not. We never thought it never dawned on us that we would actually choke out a borrower. So this stuff happens. We learned. That was one of the very beginnings. Yeah. Chokes me out. Yeah. Anyway, yeah. So beginning investors turn into advanced investors. Free and immediate fun. So we like those.
Good. Any more questions?
All right, bravo.
All right.
Bravo. Okay.
Charlie, thank you so much. I didn't want to end it because Charlie's just a wealth of information, as you guys clearly
Oh,
saw,
yeah.
right? Especially
Not
the
so bad.
questions right there at the end. But right now, we have about an hour and 15 minutes of open networking. So we have more people that showed up late. No, but now it's just open networking. If you guys have more questions for Charlie, I know he's going to want to talk more and share more stories, more
He's
knowledge.
a big mouth. That's what he's saying.
And if you want to network, right, meet other people, see what other people are doing, right? Because we've got house hackers, we've got short-term rental people here, we've got commercial real estate. I'm doing BRRRR in both residential and commercial. So yeah, we're just a bunch of different people doing different things in real estate. And so this is your chance, right? If you're new, find someone who is experienced, learn something from them, and hopefully get some action items. So when you come here next month, you got something to share, right? And then for those who are looking for anything, if you guys are looking for funding, you know who to talk to. If you guys are looking for a deal, I know Omni's got some too, right? And so if you guys want to learn about short-term rentals, Andy, I heard he's pretty good at that too, right? So my point being, take use of this time, network with other people, because this is what it's here for. And of course, have some more beers if you guys like to drink. That's it. All right. Thank you.
Thank you, bud.
Thank you.